Hi, it's Mark Ferguson with Invest for More. I'd like to thank you for watching another real estate investing video. Today, I want to talk about good debt versus bad debt, if there is really such a thing, and how I think about debt and how I use debt to make money. So again, if you want more information on real estate investing, being a real estate agent, please check out investformore.com. Tons of information there and details on my rental properties and numbers and everything. So let's get into this good debt versus bad debt. A lot of the common thoughts going around today are there's good debt and there's bad debt. Good debt is debt that's against a house or a business, something that's appreciating in value or possibly might make you money through cash flow, sales, but that debt is against something. It uses collateral against an asset that is going to make you money. Bad debt is debt that is against a car, furniture, basically consumer goods that won't go up in value. They'll probably go down in value, and they're not going to make you any money. That's the common thinking. A lot of people tend to go by good debt versus bad debt when they're investing, when they're trying to save money, and when they're trying to build wealth. I don't feel that way at all. So, I mean, some people don't want any debt at all. I am not that way, and I don't think what your debt is against, whether it be a house or a car, should be the measurement of whether that's good debt or bad debt. I think the measurement of good debt or bad debt should be, does that debt let you make more money? So, for example, I'm a car guy. I love cars. I've got 4 cars myself. 2 of them are paid off. 2 are not. I have a 2010 Audi S4. I bought that used. I've still never bought a new car in my life. But I got a loan on it, pushed it out for 7 years, financed as much as I could. And to many people, that is horrible debt. How could you get a loan against a car? That car is going to go down in value. It's not going to make you any money. But the fact is, I'm still using that debt to invest. So I could have bought the car for cash if I really wanted to. It brings me a ton of enjoyment. It's something I love, is automobiles. I could have bought it for cash. I could have, put $40,000 out of my savings account, out of my investing accounts. But if I would have paid cash for that car, that'd be $40,000 that I wouldn't be investing in rental properties. And for those of you that watch the site, watch my videos, rental properties is what I love to invest in, as well as fix and flipping. You need a lot of cash, you need a lot of capital to fix and flip or to buy rental properties. And if I'm paying cash and I don't have any debt at all, it's really hard to make either of those two businesses run as big and make as much money as I want them to. Now, I could have bought, a $5,000 car, but for me, it's just not worth it. I would rather have a nice car. I drive a ton. I try to enjoy my life as much as possible, and that's one of the things that makes me happy. For other people, if a $5,000 car makes you happy, by all means, go for it. Don't take on the debt. Just pay cash for it. But if you have to have that car, if you have to have that nice car, think about whether it's smart to use all your cash to pay for that car, or if getting a loan on it, making smaller payments every month, will make you make more money in the long run. So here's what I mean. When I get that $40,000 loan on a car, I paid, I think it was 2.9% interest. I mean, that is nothing. That is such a low interest rate. And when I'm buying my rental properties, I'm making close to 20% cash-on-cash returns. Now, that doesn't even count the equity buildup, paying off my loans, appreciation, or the tax advantages. And if you look at my total return on investment for my rental properties, it is well over 50% a year. Although, that 50% is not realized because I'd have to sell the properties, refinance them to realize that return. But the cash flow in itself, the actual cash I'm receiving, is much, much more than the money I would save by paying cash for a car or paying cash for a house and not having those loan payments. So to me, if I can make more money by getting a loan on what I'm investing in, it makes sense to get that loan. Now, if I was making 6% on my investments and the loan was 5% and there's no guarantee I would get that 6%, I probably wouldn't do that. That's probably a little too risky. But when you're talking about 15, 20% return based off money that you're borrowing at 2 or 3%, to me that's a no-brainer. I mean, I will do that all day long, have no problem with it, and I sleep well at night because of the way I buy my houses, I buy my rentals. I buy them below market value. They have plenty of cash flow. If the market tanks, if it goes down, I'll still be fine because the tenants will still be paying my mortgage. I'll have plenty of money. So we talked about cars. Another example, when you're buying rental properties, I've talked about this a little bit before, but getting a loan just increases your returns so much because instead of putting $130,000 of cash into a property, you're putting $25,000, $30,000 into it, and your returns aren't decreasing that much if you buy the right properties. You might have $400 a month cash flow with a loan. Without the loan, you may have $800 a month cash flow. Sure, your cash flow doubles, you're making twice as much money a month, but you had to put down 4 times as much money to buy a house with cash. So the ratios don't make sense to put down 4 times as much money to make only 2 times as much cash flow. That's another video, but I love debt. I love using it in the right way. Now, if you go out, buy a $40,000 car, you can't afford that car, you can't afford the mortgage payment or the car payments, you're barely struggling to get by month to month, can't pay rent, can't pay your house payment, then don't buy a $40,000 car. Don't put yourself in debt if you can't afford that debt, if you don't have cash reserves, you don't have backup. I'm not talking about stretching yourself so thin that you're walking on a tightrope that could snap at any moment. I'm talking about if you've got the cash reserves, if you've already got the money where you could pay cash for them if you want to, then maybe it makes sense to take out more debt, take out debt rather than pay cash. With my fix and flipping, another great example, I could pay cash for my fix and flips. It takes a lot of money to flip though. So if I buy a $100,000 house, it needs $30,000 in repairs. It might have $5,000 or $10,000 in buying costs and carrying costs. I have to have $140,000 in cash to buy that flip if I didn't use financing. I may make $30,000 on that flip. It might take me 6 months. So I make $30,000 on a $140,000 investment over 6 months. Really good return. I mean, that's an awesome return. Over 25%. But if I were to finance that property, say 80%, or I was able to do $100,000 loan on it, something like that, a mix of bank financing, hard money financing. I'll use the worst case scenario. Say a hard money lender charges 10% to make it easier, might be higher than that, but he'll loan me $100,000 on the same house. So got a $100,000 loan at 10% interest, which is $10,000 a year. Over 6 months, that's $5,000 in interest costs. I still have to bring $40,000 cash, my own cash, because we've got $30,000 in repairs, $10,000 in buying costs and carrying costs. So we take that $5,000 off the profit for financing. Now I'm making $25,000 off a $40,000 investment in 6 months. Okay, what's better? $30,000 in profit based off of a $140,000 investment, or $25,000 in profit based off a $40,000 investment. The returns, they don't even come close. So that's not even the biggest advantage though. If I've got $140,000 in cash, I can buy one flip and make, that one $30,000 check in 6 months. If I want to pay $40,000, I can buy 3 flips and have some money left over. Now all of a sudden, with the same amount of money, I'm making $75,000, $25,000 from 3 different flips, off of my $140,000 cash. Actually less than that. Instead of making $30,000 off my $140,000 cash. And that is the power of leverage, of using debt to build your business. Right now, I have 7 flips going. They're very expensive. It takes a lot of money to flip a house. If I was paying all cash, I might be able to have 3, maybe, 2 or 3. With leverage, I can have so many more flips, make so much more money, makes my business so much better. Same thing with rental properties. Much more returns. I can buy more properties, more advantages, much better off. And I don't care. I don't have to have the debt I'm using be based on those rental properties, be based on those fix and flips. I'm okay using that debt against my cars, against something else that allows me to have more money to invest. Now again, I'm not saying you should go out, spend, leverage yourself as much as you can, buying furniture, buying all the cars you can, if you can't afford them, if you don't have the money to invest as well. So if you have the money to invest, if you got the cash, and you can also afford to take out some more debt to bring in more cash into your business, it might let you make even more money, improve the business, and put you on a faster track to wealth. Alright, I hope you enjoyed the video, my thoughts. Please leave any comments. Again, check out investformore.com for a lot more information on my rentals, on my flipping, and being a real estate agent. Thanks a lot.